everyone. My name is Shana Orczyk Sissel, and I am the founder and CEO of Banríon Capital Management. We are a firm who is helping advisors and their clients scale allocations to alternative investments. And you are watching, you're doing it all wrong. The show where we take on myths, misconceptions of alternative investments, and we use it as an opportunity and tool to help folks get more educated on the space. In today's episode, we're going to take on the idea that all alternatives are diversifiers. It's simply not true. And I think as an industry, people are starting to realize this. I recently was asked by the Kaya Association, the leading provider of credentials to professionals in the alternative space, to write one of the modules that they have in their new fundamentals of alternative investment certificate program, which I highly recommend. Not just because I'm in it and that I wrote part of it, but one of the things we talked about in the modules was the importance of understanding, the kind of risk exposures and diversification benefits or not that you get through different types of alternatives. And so I wanted to talk about that today because I want folks to understand that just because it's not in the traditional space of long-only equity or long-only fixed income does not mean that because it's an alternative that it's a diversifier. It can offer plenty of benefits, but it doesn't necessarily mean it's going to diversify your portfolio, and it belongs in an alternative allocation bucket. So I'll start by talking about things like private equity and private credit. Both are very interesting opportunities in the marketplace. You can get really outsized returns. They don't have daily pricing, so there is this phantom low vol aspect to them. And Cliff Asness from AQR has his opinions on this, and I think he's correct in what he says. Whereas you can tout all you want that you're low vol, but you're only low vol because you don't price every day. And he's right. But for clients, from a behavioral perspective, I think my friend Dr. Daniel Crosby would agree, sometimes that's not a bad thing, because when the clients don't see the volatility on a daily basis, they're more inclined to stick with the investment. It doesn't keep them up at night. So keeping that in mind, these products are really interesting. They can have some very attractive outsized returns because they're playing in less efficient markets where they have an information advantage, and they have opportunities that you can't get in traditional markets. But don't be mistaken. They are not diversifying alternatives. They are still equity and fixed income and are highly correlated to both the equity markets and the fixed income markets. So they should not be part of your alternative allocation. They should be part of your equity allocation or your fixed income allocation. And the decision to invest in those products should be made based on your client's tolerance for illiquidity. These products are not liquid. They are in what I refer to as capital call funds, meaning that they are funds that you commit capital to. They close the fund and stop raising, and then they'll call capital as they have investment to make, and then they will pay back capital as they have opportunities to monetize the investments underneath. With that in mind, I do want to point out something really interesting that has become a topic, and I've seen a lot of funny videos and memes about this, and I think it's worth noting. Private equity, as I said, is equity and is correlated to equity markets and typically will outperform equity markets. However, that has not been the case as of late, and there's reasons why. When you talk about things like private equity, I say go read Barbarians of the Gate and read about LBOs, go watch Pretty Woman and the original Wall Street and learn about that crazy 80s, early 90s LBO craze. And in recent years, we've seen really strong returns from private equity and venture capital, because especially in the private equity space, and when I say private equity, I'm referring to what's called buyout, which is when you take a company, you buy it, typically a public company, you make it private, or a piece of a public company, you take it private, you make some changes to the structure and the efficiencies to make it more profitable and generate more revenue, more focused, and then you sell it back either into the market or to an acquirer. And so private equity really is dependent on two things: really attractive interest rates. So low rates were in their favor. You could leverage up a fund and it costs almost nothing. And you need a very, very robust and healthy IPO market, because you got to monetize these things. So there either has to be a larger company that wants to acquire that piece, or you're going to take it public again. And that's how your shareholders, your investors get, or your LPs get paid back. And in the current environment, we haven't seen those two things. Interest rates are very high, and we do not have a robust IPO market. Companies are staying private longer, so the lockup periods are getting longer. And so these are things worth considering because they still are nuanced. Now, not a diversifier. I will go to my grave with that. I do not believe private equity and private credit diversify away from traditional credit and traditional equity. If you want the diversification benefits, you got to look at things like commodities, managed futures, infrastructure, like private infrastructure, and hedge fund like strategies that are like market neutral, which are giving you that diversifying benefit. That's what you would put in your alts bucket, because I think of my alts bucket as my diversification bucket. And you got to look at liquidity terms. When you're looking at that space, make sure that the terms of the product's liquidity for subscriptions and redemptions is matched with what their underline is. I hate when I see a long short hedge fund that invests in large and mid cap US securities that tells me that I can't redeem it more than quarterly and has a 1-year lockup and quarterly subscriptions, or monthly subscriptions, quarterly redemptions, and a 1-year lockup. That is a liquid market, and you can support a redemption request. You may not want to, but you can. And I don't care about your company's infrastructure if that's the reason why you're doing it. I care about what I'm invested in. So all of these things are things you need to consider in this space. But I do want to just hammer home the point. Just because it falls in the alts bucket does not mean it's going to diversify your portfolio. You need to think about things like liquidity terms. You need to think about lockups. You need to think about how long you're going to be stuck and locked up in a product, how long it'll take in something like a private equity fund or a venture capital fund to monetize the assets underneath it. All of those things need to be part of the conversation with your clients. Are they comfortable with their liquidity? Are they comfortable with all the other considerations in the space? So with that, that is the key to really being successful in alternatives, is understanding the role they play in a portfolio and how they can or cannot mitigate risk. And I hope you found that helpful. I encourage you to please leave a comment. Tell us if there's a particular topic you would like us to take on that you have questions about. That's what we're here for. Definitely check out Banríon Capital Management. We just brought our tech platform to market, and we are looking for beta users. So if you're a financial advisor that's interested in alts, that's what we're here for. Please reach out. Remember to hit the subscribe button and like this video. And until next time, again, I'm Shana Orczyk Sissel, founder and CEO of Banríon Capital Management, and I hope to see you back here soon. Have a great day.